So now let's have a look what our table quality analysis say. It says 35. So it's not the best. Okay, few quarters ago when we looked, it was above 40. Okay, at that stage. Now it's less than 30. Why? Because I put that earnings not growing. It lost that point here because like earnings definitely not compared with last year. I already affected this type of thing. Another growth trend, future growth trend. It's not reality yet. It's just a prediction, but it tells us that they're going to make less than 10% growth. That's affected. They lost 3 points here. Another debt level, because in value line, it's still high level of debt. Okay, more than 50%. Definitely affected here. So they lost points here. Okay, and then industry. In general, industry is has low industry rank, so losing that. Now, and I'm going to show you right now that they are working on that, and definitely we already discussed that doing on growth trends. Okay, and probably the sales and earnings level will be improved in the future. So the points where it lost points, they're going to be improved. So the company now not for like by quality company, but definitely can be there in a couple quarters time again. Now, if you look at price, we can see that has 48 points out of 52 possible. So it's actually in a very, very, very good position right now. It's definitely undervalued. And if we just usually do this calculation, which we always do, that's maximums during the last 5 years. These are minimums, price minimums, and this is earnings for those companies during 5 years. When we add them together, divide by 5, we get averages. So that's average high, that's average low, and that's average earnings. So we need those numbers in order to calculate average price earning ratio, high price earning ratio, and a low price earning ratio. So this price usually happens when the investors, they're happy about the company, everything looks rosy, they love it, and they overpay. So what we do, but earnings the same, right? So we divide 103 by 55.1, we get about 18 times. So we know that in average, when at the highest point, people were paying 18 times of the earnings of the company. And when everything was bad during last 5 years, something was going wrong, they were paying in average $70, which if we divide by the earnings, it comes like 12 times. So if we assume that sometimes in the future, and that's what value line is telling us, is going to be $7.5 earnings in the future, okay, we know that sometimes people are happy and they pay for this company more, and it's going to happen, you know. So some good news come up, something happens, and people will be paying that. It means that the company price might jump to $135. Okay, that we know that's the maximum. And then we think, okay, fine. What if they're going to pay the lowest, like P ratio in average? And here, look at this. I already put 18 by 17. So last high price is 135, not 96. Okay, in this case, it's even Gina going to be even higher. Okay, so it means that this number is going to be even bigger. So if that number was bigger, so because the P would be higher. So sorry, probably I missed the calculation. Yeah, you're correct. It's 135. So guys, that's a very good point, Gina. So you noticed it. So guys, when you calculate yourself, put 96, and is it 72 here wrong? No, 72 is the right one. Yeah. So Gina pointed out that I put here 135. If I put 135, this average would be higher. This average would be higher too, and it means that highest price would be higher too. I don't know, Gina, what kind of price here appeared if you calculated it yourself already. So if you have it, tell us. 146. Okay, you see it's $7 or no, $11 even higher. So which is better for us. Okay, I was conservative, let's say, in this particular case. And low was $90. Okay, and how lowest is 90? Lowest still has to be 74 because I presume I put everything correct here. It should be the same. All right. In any way, yes, correct, $90. I explain why, Gina, I have not 90 because why I have 70. The reason for that, what I did, instead of putting $7.1, which value line has here, 745 last year, I put conservative. I took it what they expect, and I put $6.1. So it's like what they expecting this year to cover. And I think, okay, if they're paying in general 12 times of their earnings in a worst case scenario, the price has to be 12 multiplied by 6. It has to come up 74. And now it's 55. So it's definitely lower than that price, much, much lower. And that would be our lowest point to buy it. And then until 94 we buy, and after 94 we hold, and after 115 we're going to sell. Okay, that's the thing. Gina, do you understand why I have it 6.1 here, not 7.45? I just wanted to be more conservative. That's the reason. So kind of, yeah, you can change. You change it. You know where you change? You change it when you put in a dividends. It's on the top of the spreadsheet when you put earnings and dividends, because this number comes from there. So if you change instead of 7.45, you put and $1 in dividends, you just put 6.1. It wouldn't affect the calculation there because it's still you're getting 4 there. Can you try it? So if you look at there, so you will see it there. All right, perfect. And that's how we get 42 points. Okay. Now the company had earnings 24th of November. So the next earnings probably going to be somewhere in February or in ZAX. I just checked after I've done this presentation. They're telling it's going to be 8th of March. So we have nearly 3 months to play with options if you want to play with options. Okay, and you have no risk on that. Okay, guys, is it all clear on that part? And then if it's all clear here for pluses, and then we'll go for kind of balance sheets, profit and loss statements, and I want to point a few things there. Okay, great. Okay, let's have a look at financial statements. First, we're going to look at income statement, and that's quarterly. And we're going to compare third quarter, which just finished, and we're going to check the quarter in the previous year. Okay, and that's what we see here. Last year, in third quarter, they had 1,186 million in sales. This year, they have 1,156 million in sales. So they have 30 million less in sales. Okay, then if you look at the expenses, selling expenses, they had 370 million here and 375 million here. So the expense level was about the same. Okay, and the cost of revenue was also about the same. So 1 million less, here 3 million less, so it's only 4 million. So they sold 30 million, but expenses reduced only by 4 million. So definitely we can see the expense level didn't go down as much as sales level went down. Okay, and that's why you can see operating income from 32 million, it went directly to 5.5 million. Okay, then pay interest, and they become kind of in loss in this particular case. So diluted normalized earnings per share, they had 20 cents instead of 29 cents. Here loss instead of profit. Okay, you understand that. And but a lot of expenses here, it was related to IT transaction. So the expense level went up. We got that. Okay, we already noticed kind of this stuff before. So next thing, balance sheet. And this is actually when people look at the earnings announcement, why do you think, how do you think they're going to react if they see that the company which was making money all the time is telling that they have 20 cents loss? Are they going to buy shares at on that news, or are they going to sell shares on that news? What do you think? Sell, definitely. Panic sell. So that's why the company went down, and probably it's triggered all the stop losses which it had, and the company went 35% down on that earnings. So that's how it triggers that, because people are lazy to, like, too lazy to read deeper. And now look at this, what we're going to see here. That's balance sheet. What I wanted to show you here is total receivables. That's Dory, to answer your question. Look, second quarter, $1.8 billion in receivables. Third quarter, 737 million in receivables. 1.1 billion was paid by clients. Do you think are clients paid, or maybe something happened here, what Dory pointed out? The credit, like the debt, was transferred from the company balance sheet to that financial institution, to financial company. So, and the company paid to Signet this money. So company reduced that risk. Yeah, like if you go to, like, definitely you can see that the receivables, and then you can see that the total assets, they reduced. And then you're correct. So we have to see it somewhere, right? So definitely we have to see it. So the next thing what's happened, so they got cash. I presume you understand. They have cash. And the question is, what do they do with that cash? And we'll see it now a bit later, because we're going to look at cash flow statement as well. But this thing which I wanted to point, because that transaction is definitely working. So they're reducing that risk which they had before. Okay, let's have a look at total current liabilities. What happened here? They had 1.8 billion. Now they have 1.3 billion. Remember when we told that they have about $900 million in current liabilities? So definitely it's reduced now quite a lot. So nearly what, 600 million went down, which is pretty good, right? In this particular case. And look at total debt. Remember in value line we saw it 1.7, 1.6 billion. And look at this now, 9.88 billion. So even by looking here, we understand that they got this cash. And what did they do with it? They paid the debt. So they reduced their debt level quite a lot. Okay, and we can check it like a bit later, but definitely we can tell it straight away. Okay, and look at this total equity is about the same. Okay, book value is 14.263. It's tangible book value, $14. Okay, is it all clear about balance sheet? I'm not going to go in details, but you can look at more precise on that one. And look at now we can check the theory, which Doris asked. So you see that's the cash flow, and cash flow always is broken down to three major activities. It's operating activities, it's cash flow from investing activities, and then financial activities. And operating activities, it's everything what's related to operations within the company, okay? And capital is whatever they spend money to capital. And see what happened. They usually had like 360 last year, same quarter. And this year they have 1.48 billion cash positive. Where this cash came from? If they have same amount of sales and they have even less earnings, we kind of can get non-cash items, 961. That's receivables which received from transfer of that specific company. Okay, that's what they got. They got this credit back. Okay, and then what happened? Other investing cash flow items. You see, they had very small, like less than like $1 million here. Where did it come up this 333 million? What happened? What do you think happened here? Where this money went? Who remembers? Value line told us already about that. Correct, Nick. Yeah. So they bought that company. So they spent that specific money for buying the company. Okay. So they got 1.4. They spent 3.3, 330 million to buy that company. So the next thing, 84 million gone to where? Dividends. Good. Investor. So here 460 million issued of stock net. So they bought stock for $460 million. And then they paid debt $770 million. Okay. So in general, from financial activity, they spent $970 million. So, and they have positive cash flow eventually. Probably yes, Jeremy, definitely will be. How quickly it will be going on, I don't know. Now, the reason why I don't know, because the company which they're now operating, it's US located, but the company has 3 markets where they sell. It's US, Canada, and UK. So I presume it just takes some time to transfer like each country because it's different jurisdiction. Okay, if that financial company, I don't know just about that company, if that company has offices in all those countries, so I presume they will do the transfer on a later stage. Maybe they had only partially transferred because financial company, I'm sure they're going to check what kind of credits they can expect, like what debt they would buy, what debt they're not going to buy. Maybe Signet themselves, they don't want to sell all debt. Maybe some debt which is due within the next few months, they're going to keep maybe, and people will pay them instead of transferring this cash. So, but definitely they're going to reduce that level of receivables, definitely. So they spent the transfer of the debtor book on that. Didn't get the question, Jeremy. Oh yeah. They did. Now I got it. So yes, they received from that cash, they spend here. What do you think, by the way? Was it a good allocation of the money or not? They got all this cash. Yeah, definitely. Definitely good thing, right, Dory, Gina? So they pay dividends. It's a good thing to have. They paid some debt. They bought more stock at these specific prices. That's probably the fantastic thing to do. So yeah, definitely the good thing to do. Okay, so guys, that's something about that specific company. So what do you think now? What's your opinion? Is it a bargain or is it a value trap? Hallelujah. Going and buying, right? Yeah, so definitely looks like a really solid company. Now, not so long ago, about 3 weeks ago or something like that, I was at the event and there was a guy who was an analyst in Charles Schwab's for the last 35 or 40 years, like very, very long time. And he was saying that when he is buying the company, he's not only looking at fundamentals of the company as we did, he's not only looking at the reasons why the company dropped in price and what to do and what the management is doing, it's all that, but also what they're paying attention to is the market emotions, how people reacting on that particular news. Because we can be right and we buy this company, and then, but the market, they don't know. I mean, majority of people, they are too lazy to read the stuff, and they say, oh, sell, sell, sell. And the company will be going down. and you will be so frustrated in that. You say, freaking hell, how can it happen? The company is great, why don't they buy it? But they don't know about it. They're still emotionally involved that something is happening within the company until it becomes so obvious that they have to buy. So the question is for you guys, how would you know that what other investors think about this company? Where can you go and see it? Because in our club, definitely you won't find out it, because in our club, everyone is knowledgeable and we can read reports, right? So, but definitely somewhere you probably can see the sentiment. So where will you go? Yeah, correctly, Dory. It could be stock tweets. The easiest way, what I do, I go to Seeking Alpha. I go to any article related to that specific stock, but I read comments. And oh my God, comments usually, they definitely tell you what other people think about it. Okay, especially if you look at some kind of article which is not heavy fundamentally involved, because those guys, they wouldn't be commenting this type of articles. Usually if article kind of, maybe based on technicals or stuff like that, no, not very deep article, you will see a lot of comments there, and you kind of you will have an idea how people might react. And what Dory is saying, stock tweets, I've never used it, but maybe something like that. Or another thing is chat. Jeremy is completely right. We can go to there. Okay, so now fundamentally it's all clear, guys. If you have any questions about fundamental, ask. If not, we're going to continue to technical analysis. And that would be more also kind of related to emotions of the market and technical traders. So all clear? Are we going to go for charts? Okay, great.